I'm really pleased to be speaking with Dave George today. Dave is for Finance for Enterprise. He has vast experience in commercial financing. Welcome to the channel, Dave. How are you?
I'm all right, thank you, David. How are you?
Yeah, surviving in these sort of torrid times, really, and hopefully taking this opportunity to help lots of other people. Just before we get started, just a quick reminder to people to please like this video and please subscribe to the channel. And our website is business-questions.com, where you can see all the videos we've released. But enough of that, let's get on to the information with Dave. Dave, tell me, what is commercial finance?
Commercial lending, is offered from many lenders, be it from the high street banks to, I suppose, the second tier lenders, which are, I suppose, people like Funding Circle and other fintech loan suppliers. We tend to fit in, I suppose, below where the high street banks are, and I suppose in competition with, if that's the right word, or probably underneath the fintechs. But I suppose what commercial lending is in its primacy is different types, different ways of borrowing. The first and usual type is usually for cash flow or working capital, which can come in many guises, such as invoice discounting, which is when you borrow against debtor receipts, and it's usually provided by banks or specific invoice discounting firms. There's such as long-term debt, which is to do with commercial mortgages, which are usually done over longer terms so that you can buy trading premises or storage premises or multiple types of premises so that your business can operate on multiple sites. There is even more short-term cash flow lending with the new fintechs, such as people like Lendable and MoneyStream and things like that, who lend on an unsecured basis, but usually at a higher interest rate and a shorter term. So what I've found in my experience over the years, that there is somebody out there who will lend against most things. There are even people who will lend money against your tables and chairs. They will secure lending via your assets in your business, and that could be anything. It could be your desk, it could be your computer. I mean, normally that is probably the last chance saloon where you're looking to get lending. But from my experience, there is a lender out there usually, but it usually comes at a price, either by way of a lot more security or a higher price to pay to borrow.
So the process of actually going to borrow money for your business, obviously it's a lot more complicated than a personal loan. A bank is going to look at your cash flow, your profit and loss, your balance sheet. In general terms, how long does it take for a lender to make a decision?
Well, it should be quite a quick process, really, because so long as they have the information to hand, and that is driven by the client who's looking for the money. Once they've got the information to hand, then the decision-making process should be relatively quick. Depending on the type of borrowing it is, so specifically if it's secured against property, it is going to take a little bit longer because the lender has to take a charge over that security, and that is dependent upon searches coming back. It's dependent upon solicitors actioning documents, and it's dependent on the bank issuing the charging documentation so that the charge over the piece of security can be can be perfected, and then the loan can be drawn. I suppose if you're dealing with somebody like Finance for Enterprise, where our loans are unsecured, then it can be quite quick. I mean, we have done lending. We call it the Craig David situation. I don't know if you know Craig David, but one of his songs is I met them on a Monday, did this on a Tuesday, and then on a Wednesday. So yeah, one of my colleagues in the office basically does work like this. He'll get a phone call from a customer on a Monday. He'll go and see him on the Tuesday. He'll get most of the information by the Wednesday. The credit report will be written by the Thursday, and it'll be sanctioned on a Friday. So, it's quite, we can do it quite quickly because everything we do is in house, and it doesn't go down to a bunker somewhere, to be processed like everybody else's stuff. So, we can manage our workflow quite easily because we've got the people doing the security documentation and the facility documentation sat behind us. So we can shout over and say, look, I need this one quicker because they need the money quicker. So I suppose to answer your question, it can be anywhere within, I suppose we can get it done in a week. Some of the banks are taking months, unfortunately, and all I can put that down to is the fact that the banks are tending to shut up shop at the moment, purely down to the COVID pandemic, and they're looking after their own clients and not looking after new clients. So I suppose this is where what I would call alternative funders become of paramount importance. And alternative funders are people such as the fintechs, such as people like BBs, different banks that are, I suppose, they work alongside, but I suppose underneath the mainstream banks. Mainstream banks, I mean, like Lloyds, HSBC, Barclays, and they tend to step in with probably, I suppose, more sectoral deals, and I suppose they get involved where the mainstream banks don't have an appetite for that sector or specifically for that company. So I suppose what I'm saying is, to cut a long story short, it's entirely dependent on the organisation that you go and see. But what we are seeing is that credit sanction is taking longer, and therefore funds getting into businesses, banks are taking longer. So I suppose that is probably one of the first questions that you need to ask when you're speaking to a lender is, how long is this going to take? Because I need the money by the end of February, and if you're not going to get it to me till April, then I really can't be doing business with you. So I suppose one of the questions that you need to be asking at the forefront is, what do you need first of all from me, and how quickly can you get me the money after I've given you that information? And most will say, "Oh, we'll get it done within a couple of weeks," but a lot aren't doing that.
Yeah, not the reality. Excuse me, not the reality of the situation. I suppose you have an asset within your company, which may be a piece of machinery, and that piece of machinery is worth £100,000. What sort of loan to value would ordinarily be given to that? Assuming also that the piece of equipment is probably a depreciating asset.
Yeah, I mean, the things with assets, they are a specialist lending requirement, because, as you say, what we call chattel or the asset has to be valued. And obviously you have to take into the account of depreciation. You have to take into account hours that the machines worked. You have to take into account portability, whether it's easy to if it weighs 500 tons and it's concreted into the floor, then it's going to be really difficult for them to, if the company defaults on the loan, it's going to be difficult for them to move that. So obviously the cost of moving it and digging it out of the business premises is going to be taken off the value. So it's not an easy question to answer, that one. I mean, from my gut feeling, I think if you had £100,000 worth of kit, and it was relatively easy to get out, and it was easily identifiable, then I would think you'd probably get up to 40% of that. I would think, depending on the appetite of the lender. I mean, I suppose, by shopping around, you could get others that might give 50 or 60%. But I think it would be wouldn't be a lot more than that, because of the fact that there are so many different things that affect the value of that, and especially in situations where people are buying the machinery after it's defaulted on the loan, they'll try and get it for next to nothing.
Yeah.
So they won't pay the full price for it. So the lender has got to take that into account as well. So there is value in your asset, but it will be valued, I suppose, to the benefit of the lender and not to the benefit of the person borrowing the money.
And how will lenders look at the current situation? Because up until March 2020, trading could be absolutely fantastic, a great 2019. 2020 absolutely wiped out. We had to close down for X amount of months. Obviously, the bank's going to ask for your financial information. Are they going to ask for literally up-to-date information on their finances, or on the last filed report to Companies House?
No, I mean, lenders will look for up-to-date information. That information might be negligible, but there will still be things going out of the bank, where they're having to pay for suppliers, they're having to pay for utilities, they're having to pay rent if there isn't a rental holiday there. So there will still be things going out of the account. And what the CBILS loan does at the minute is it takes that into account, that we realise that some businesses are going to suffer. Some aren't suffering. Some are flying. But the ones that are suffering, usually in the retail sector, or I suppose in manufacturing, where their business was reliant upon the retail or hospitality sector. So say they're manufacturers of beer glasses, for instance. The need for beer glasses at the moment will be minimal because people can't go out and drink. So they would be struggling, I would think. Whereas hotels and shops and restaurants are struggling. So, but people like, I suppose, people who manufacture PPE equipment, for instance, and I've always done that. They're doing very well, thanks very much. But I suppose the fact is that each sector is different, and each sector has its own risks. I suppose what we look at as lenders is, how were they doing before the COVID pandemic came? We can see that there's a need during the pandemic, because obviously businesses slowed down, and there are still costs that need to go out of the business to keep it going. I mean, obviously furloughing helps and all that sort of stuff, the money they get from the government. But but the fact is that how do we, as lenders, how do we forecast what's going to happen in the future? We can't.
No.
We can't see that this business is going to survive. We can't see that this business is going to trade through COVID. We don't have crystal balls, but what we do have is we have experience, and we look at the people who are running the business. That is very important to us. It's their experience, their flexibility, their willingness to change, and willingness to I suppose do things a little bit differently than what they were doing before, because they have to.
And especially in these current times, would it be advantageous, say, for an established company to bring in a non-executive director to sit on the board? Would that sit favourably with the lenders?
To be honest with you, I suppose in our arena, in a small to medium business arena, that would be quite a luxury to have a non-executive director. I mean, if it was one of the larger companies, then yes. I mean, I think that the major support that you could get would be a financial director at this point in time. Finance directors are very, very important to businesses, but most smaller and medium-sized business can't afford them. To employ them full time is very costly, because they're very experienced people, and they bring a lot of value to a company, and they also give banks a lot of, I suppose, confidence in the business, purely and simply because there is somebody who's a professional running the finance side of the business. I mean, there are other ways of doing things with finance directors. One of my connections, who I've been speaking to quite recently, he's an ex-accountant who basically offers his services as a finance director, but it's an as and when needed. So you're not paying for the full finance director all the time. You pay for him when you need him, and he's whereas an accountant will probably charge you £250 to £300 an hour to do the work that you want doing. He will charge something like £50 or £60 an hour, which is a big difference to a smaller sized business. So
in terms of planning as well, actually, if you know in a year's time you want to finance a particular asset, taking on a part-time or consultant FD now, actually, what a great thing to do and increase your chances of being successful.
I think so.
And the general health of the company as well.
I think so. Yeah, I mean, there's a lot of people out there who run their own businesses, managing directors, and they do everything, and they're fantastic. They look after the sales side, they look after the strategic side, they take an overview of the financial side, and it's usually not their area of expertise. I mean, their area of expertise is usually selling and building relationships and getting new customers into the business. It isn't looking at figures and strategizing, where do we need this, and when's this going to hit, and when do we need the money in the bank so that we can pay this. And a finance director can add great value in that area. And I suppose what I'm trying to say is that you don't have to have a full-time finance director, but if you can afford one that's part-time, it's something I would suggest very strongly, especially during this pandemic, because as we all know in business, cash is king, and if cash runs out, then you're finished. And the business is gone, and that could be a 100-year-old business, or it could be a 6-month-old business. It doesn't matter. Once the cash is gone, then that's it. You're finished. Your lifeblood has gone.
Which does bring me on to another question. When obviously startup finance, but in commercial finance, how many years of trading history would you ideally be looking at?
I mean, ideally, finance for enterprise, we look at established businesses. I mean, startup loans we do via the British Business Bank. We're a delivery partner with those, and that's for a business that's been trading under 2 years currently. With the commercial funding, it's usually two years or more that because we would like to see some sort of trend in their accounts, so that we can see what they've done previously. Are they improving? Is business deteriorating? Are they burning cash? What is the issue here that is causing them the hole in their cash flow? And you can't see that from just one set of figures. You have to see, over a period of time. You can see trends, and there are trigger points in the cash flow cycle that we can work out, where we can say we can be proactive, and to say to the client, look, you need to. There's going to be a problem in July, say. That's when we need to get the C-bills loan in for. You're going to be down about 150,000. So if you're going to be down 150,000, we really probably need to build in maybe a 50 grand buffer or something like that, so that if our figures aren't quite correct, or something comes up, which it inevitably does, that there's cash there. Because what I always would rather do is I would rather lend a client more money than they need than less money, because more money they can pay us back anytime they want, because we don't charge repayment penalties for early repayment. So if I've given them too much, then they can give us it back.
Yeah.
But if I haven't given them enough, then it means another credit application, and that time it takes to get the money back out to them, it could be the point where they fail. So, apply for more money rather than trying to get it bang on, or I need 150,000, but I can manage with 100. That is, especially in these times where there's so much uncertainty around payment from debtors, and it's important that your cash and your working capital is kept where you need it to be.
Yeah. Let me give you a little scenario. I was going to invent one up here. Let's say someone was a plumber. So it's an in-demand service all the time. It always takes weeks to get a plumber. Let's say they got into some personal financial difficulties 4 years ago. Then they got made redundant from their job or whatever, or they moved area. They said, I'm going to start up by myself. They started up by themselves, then they've turned themselves into a limited company. They then come to you with 2 years trading profitably as a limited company. But they want finance because they actually want to expand their company. They want to get a new van. They want to hire someone else. How's that going to affect them having their bad credit history from 4 years ago?
It depends, I suppose, on the institution that you apply for. Most banks will see adverse credit information as it's an electronic check, and they will say yes or it will say no. It doesn't go into why.
If you apply as a company, they're still going to take into account your personal financial situation.
Oh yeah, because a limited company is controlled by its owners. So why would you lend money to a business if the director can't manage his own personal finances?
No, exactly.
So, it's folly, but sometimes there's a story, like you said, and most banks use a credit scoring system which will say yes or no. It won't go into the details. It will just look at the credit file, and if there's defaults or CCJs, it will just kick it out and say no.
Yeah.
Some banks will take a view. I don't know who they are because I haven't worked for a bank for a while now, but some banks take a view and say, well, why did it happen? We always look at the credit side, the credit file of the directors and the shareholders, and we get into some rather unpleasant conversations about that, because some people just don't want to pay things back. Yeah. And if they like that, then they're not for us, basically, because we know that if they're not going to pay the personal stuff back, then they're not going to pay the business stuff back either, because the business stuff is limited by liability. So why would they?
And on a side note to that as well, if they can't sell themselves to you as a lender, then what hope have they got of selling their services to some customers?
Personally, and I say this personally as a lender, as somebody who writes credit reports and who is responsible for recommending loans to sanctioners, is I would say to me, 50 to 60% of my decision will be based on the people behind the business. So if I, and I'm not talking about liking them or disliking them, that's irrelevant. It's whether or not they can show me that they know what they're doing. They've run a business before and they have experience doing it. They have a strong team behind them. They have a good workforce that is loyal, and that's only created by having a good boss. It's not created by money or anything like that. If you've got a good boss, you'll go to the wall for them. And the fact is that you can see that through speaking to them, and you can get that through speaking to their employees as you walk around the shop. And the fact is that the people behind the business, to me, are the deal breaker. They could have a fantastic business, they could have fantastic accounts, and they could have fantastic projections, but if the people aren't right, then I won't lend to them, because the people have to be right. Because the fact is that, you know, they know more about that business than I will ever do. And if they can't run it properly, and I can see they can't run it properly, and they can't run their own finances properly, and they've got issues with you know, with creditors and with people they owe money to, then, you know, then how will I get my money back from my loan? So, you know, yes, it's incredibly important how people present themselves, how they presented themselves in the past, you know, and it's I suppose it's, to me, it's paramount. And I would think, you know, a lot of lenders, especially the older lenders, will look at the people first and then look at the figures. You know, the figures, you know, we can work with. The people, if they aren't right, we can't.
No, that's a very good point. Just to, you know, to finish up on this particular section of the interview, that, you know, and people buy from people, even going for lending.
Exactly.
Just it holds true. And we're going to continue our conversation on the member side of the website. If you're not a member of business-questions.com, please head over to the site. It's £50 a year to join. It's full of insightful videos giving you lots and lots of knowledge. And they're also advert free. We host them on Vimeo as opposed to YouTube, and there's various other benefits. So please head over there and join up, and remember to subscribe to our YouTube channel, also like this. But we're going to continue to chat with Dave now on how to actually plan to present your application to a lender, which I think is going to be really, really golden information for everyone.